So, good evening, everybody. It's Richard Bowser from Property Investor News. It's the usual format. We try and keep these short and sharp, packed with content, and at the same time giving you the opportunity to get some interaction, ask some questions on the back of recent articles in Property Investor News, and tonight is no exception. I'd just like to say to all of you who have been emailing me in and or some of you texting, a couple of you phoned the office. Appreciate your comments on the previous webinars content that we've done, and thank you very much for the almost exclusively positive comments. Long may that continue. So I'm now going to just mention who I am. So I'm Richard Bowles, editor of Property Investor News. For those of you who are not subscribers and or new to our webinars, Property Investor News has been running now as a print magazine for 18 years, and we're about to go into our 200th edition of the print magazine, reflected on our website by the fact that there are now over 15,000 articles which are keyword searchable by topic, 250 odd videos. Mostly those are based at people's projects where we interview landlords and developers, what they're doing at the same time as doing interviews with them, which then go into print magazine. And of course, we've now got a growing library of webinars that we've been doing for about 4 years now, but we're increasing the frequency of them, and we're looking to expand these even more. So keep an eye out on your inbox for the invites that we'll be sending out. Just a recap on the May edition that was published just over a week ago now, and the key topics were opportunities ahead for investors and developers. That was from Richard Little. The key article written by ourselves was about climate change and its impact on property. Mani and Romy Chopra, they were two of four interviews that I did in terms of content for that article, the challenges that developers are facing in respect of the last few months and dealing with the impacts of COVID. John Corey, our well-respected and long-standing contributor, also put together a piece for the May magazine on the unexpected economic opportunities. Manish Kataria, he was in his article, which is going to continue with tonight's presentation. He focused on stocks and shares, the property markets, the economy, and forecasts for property, and his thoughts on what will and won't be working in the months and years ahead. We had a great presentation from David Kemp last week on planning, an excellent webinar that David and I did last week, joined in by Sarah Nasrallah and Remy Connolly Taylor, and that was on planning. That was also following through from an article in the print magazine. Then we had an in-depth report from SAFE, Adam Lawrence and Patsy Richardson, which was all about navigating a changing world, a bit of blue sky thinking there, looking into the future. And part of that article was looking at the impact in terms of commercial property trends ahead. So that again was an interesting article, and part of that was covering the industrial and logistics sector. And then finally, a couple of other articles that were in this May edition: the impact of coronavirus on auctions and future property pricing at auctions. That was written by Jay Howard, who will be joining me in another webinar upcoming on the auction sector. And Patrick Sullivan, who's a new contributor, a very experienced landlord. He wrote a piece for us on regulation and how it's impacting on landlords and agents. So that's the content of the May magazine. Believe it or not, we go to print later next week on the June magazine. So for me, the May magazine is consigned to the history books, and I'm already knee deep in the June magazine, along with my colleagues putting the next one together. So if you're not aware of Property Investor News, this is the only sales pitch tonight. It's £7.95 per month via a quarterly direct debit. You get access to all of the content that we've published over the last 18 years. It's all about helping you on your journey to property investing success and minimizing the risks ahead. And at the moment, as we are all very aware, the risks have grown, and we will see some of the repercussions unfolding in the weeks and months ahead, and Manish will give you his thoughts on that. Right, Manish, over to you. So your screen is there.
Great, thank you, Richard. Good evening, Richard. Good evening, everyone. And yeah, my name's Manish Kataria. I was actually I've had an article in the May edition of Property Investor News. I'm looking at it right now. It's on page 30. So if you want to refer to it, feel free. And so I'm really wanted to sort of talk about the article and really the critical question is, where does the market go from here? We've had a lot of developments on the macro side, on the economic side, lots of questions, lots of debate about how things are going to end up, and this is all new to a lot of people. I often say history doesn't always repeat itself, but it often rhymes. And yeah, and we sometimes have to draw upon historical sort of events, historical recessions, to try and get some sense, try and make some sense out of what's happening right now. So that's what I hope I can sort of give you a flavour of, where I think the outlook is going. And based on a lot of the analysis that I've done using historical precedents. So yeah, that's what this presentation is about. Okay, so that's what we are going to cover. Firstly, I'll talk a little bit about myself, my background. We'll do an asset class comparison. So I also had an article which was in Property Investor News, I think back in February, where we did an analysis of various asset classes in terms of their historical returns, in terms of their historical risk and effort required. So that was a sort of pretty comprehensive asset class comparison, not contaminated by coronavirus or any of the issues we're seeing right now. So that was using the good old days where everybody was healthy, but again, it's still very relevant because all of these things are relevant when we put things into context. Moving on to equity market moves. So, what has happened? I mean, it's been a real roller coaster ride in the equity markets. We had that massive collapse in February and a huge rally since then. And, can we make sense of it? I'll try and sort of give some information in terms of, what's been causing the market moves and why they have rallied in the way they have done. My central thesis is that this is not going to be 2008 all over again. It's going to be better. It's our starting point is a lot healthier than 2008. So, if you were to, you read the newspapers or social media or TV headlines, news headlines, you could be forgiven for thinking, this is going to be a lot worse than 2008. And in some respects, it might be for a shorter period of time. Okay, so that's just the key thing I want people to take away from this is that the end result of this recession is not going to be anywhere like we saw in 2008. We'll go through a couple of property market indicators in terms of what we're seeing right now compared to historical events. And then, yeah, the aim of this is to keep it pretty interactive and Q&A. So I'm hopeful we'll have time for Q&A at the end, and I'll try and sort of go through my slides as quick as I can to leave as much time at the end. So hopefully we'll have lots of questions. Okay, so that's what we will cover. Just quickly about myself. So I'm a professional investor. I've worked for the names you see there in terms of my corporate career in the city. So I managed money professionally for JP Morgan, Insight Investment and Russell Investments, managing global equities mainly. But I also did private equity, fixed income, fund of funds, and a little bit of property investing as well, but mainly sort of liquid global equities. Okay, and I'm still in the city, but nowadays I work on a part-time basis. So I work for a fund on an advisory basis at the moment. So that's a part-time role, and I've been focusing more of my time since leaving the city full time, more of my time on property and investing in other people's deals, which has been a real key area of focus of mine over the last 2 or 3 years. So, I've been involved in property. I have my own property portfolio. I've done some developments there. You see on the bottom left. I own HMOs, single lets, and serviced accommodation as well. So really, I cut my teeth on due diligence, risk management, investment analysis on a professional basis, and now I'm bringing it together in a sort of in a property context now. Okay, so I talked earlier briefly about historical equity performance and asset class returns, drawing upon some of the analysis I did for an earlier article. So this is I just thought I'd bring this in for context. Okay, so these are asset class returns for stock markets. So the FTSE 100 is a proxy for stock markets, the red line. The green line is direct property on a leveraged basis. The blue line is secured loans, which, as I said, I've been putting more of my time and effort into. And the grey line is direct property on an unlevered basis. Okay, so you can see immediately the thing that stands out is the volatility of equities, and this is before 2020. Okay, so this is 5 years to 2019, the good old days, the healthy days. So, let's look at the FTSE 100, down almost double digits in 2018, and up, was it 19% in 2019? So clear volatility there. 2020 would be off the chart. So we're down currently, down 20% on the FTSE. A bit better in the US markets, but overall, markets are down this year. And it kind of goes with the territory, right? So stocks are volatile. We're always going to have that. Whereas, the least volatile asset class here is secured property loans, and you get year in, year out, consistent returns with low volatility of those returns. And property is slightly different because you get good years and not so good years, but at least you have the ability to add value. So each of these asset classes has its own merits. Okay. But it's not just about returns. Okay, I always say to people that returns are it's just one metric you should be looking at. In fact, whenever I look at an investment proposal, the return is the last thing I look at. The first thing you need to analyze are the risk, is the risk profile, right? Try and get a really good handle on risk, because without knowing the risk, the return number is pretty meaningless. Okay, so always look at return versus risk. So all I've done here is take the previous data and put it on a chart, comparing risk to return. So on the x-axis here is the volatility of returns. That's one measure of riskiness of an asset class. Okay, so the green dot is global equities, which is something I brought in here, which wasn't on the previous chart, and annual returns on the y-axis here, and so just comparing risk versus returns for 5 years, and looking how they compare. And as a professional investor, you are forever looking for those asset classes that give you low risk and high returns. It's a bit of a holy grail in investing, but when you find an asset class that gives you that, that really is having your cake and eating it. Okay, so here's, you got development loans, property loans, low risk and high returns. But you've also got global equities, which also give you relatively high returns, but with higher risk. And that risk can be managed by diversification and all of those things as well. So both have their merits. The poor old FTSE over here, the orange dot has been a dog. And then for good measure, I've put in here UK house prices and corporate bonds. Okay, so both of those charts just give you the historical context. Now, the big question was, why did the market rally? It's been such a popular question. I've been asked it so many times. In the face of lockdowns, in the face of death rates, infection rates, media frenzy, media headlines, incoming recession, unemployment that's about to hit highs. Why has the market been rallying? And it's a really good question. What I would say is that the market always looks ahead. The market never ever looks at today's headlines. It's always looking 12, 18, 24 months in advance, okay? That's the focus. Today's GDP headlines are yesterday's news for the markets. The death toll, it's horrific, and that's why the market collapsed like it did in February and March. But as soon as there was a glimmer of hope that those death rates, those infection rates were kind of showing some green shoots, the market started rallying. So what on 19th of March, actually, I remember the date well because it was that's when I sent an email to my investors, and I wanted people to just think about the market getting crushed as it was at that time, and I wanted to plant a seed in people's heads about looking to the other side. Yes, at that time, I remember the FTSE was selling off 10, 12% on a daily basis. The headlines were just horrific. And I wasn't suggesting people should be buying then. I was saying to people, maybe put together a hunting list of stocks that you might like. You like certain themes, quality stocks that would be good to pick up once we've got some good news on the horizon. And I sent that on the 19th of March, and lo and behold, 2 days after, far earlier than I expected, the market bottomed. And actually, the market bottomed on the very same day that Boris Johnson, I should say, sorry, his boss, Dominic Cummings, decided that we were going to go into a lockdown. So, we went into a lockdown on March the 23rd, and that was the day the FTSE bottomed. Okay, and people couldn't get their heads around that, and I go back and say the market looks ahead. Okay, so here's a chart showing how the market has looked ahead, and I've taken this chart of the FTSE 100 index, taking it back, where are we, 12 years, so going back to the previous recession, just before the previous recession in 2008, and I wanted to demonstrate how the market looks ahead. So you look at this red arrow. In October 2007, that's when the FTSE 100 peaked. Okay, that's when it reached its top and started selling off pretty aggressively after that. Now, that was the time of that peak. Was no one really expected what was about to happen. It was about 4 or 5 months before Northern Rock collapsed, and some of you may remember those sort of news headlines, the news footage of all those people queuing outside Northern Rock trying to get their money out before it collapses. That was 4 months after the market peaked, and the peak was around 12 full months before Lehman collapsed. And when Lehman collapsed, that was the iconic moment of the global financial crisis. Okay, so well before all of these events happened, and 14 months before the UK formally entered recession. So the market, more often than not, gets it right. And it's really uncomfortable to say this to people and for people to accept that the market does get it right more often than not. But it does. And I could have taken this chart back decades and we could have pinpointed every event and it would have been the same. That the market's always ahead of the reality. Okay. And there's various reasons for that, and we won't go into all of that now, but the market is the best leading indicator of what's about to happen. Okay, and it works the other way as well. So the market bottomed in 2009, March 2009, and that was 12, 14 months before the UK finally came out of recession. Okay, so it works both ways. Fast forward to what we're seeing now. Fast forward to coronavirus, and we had the same things which I described earlier. We had the lockdown, a full 30-35% after the market had a full 35% of a market decline, and then the lockdown was announced, and then since then we've had a pretty big rally. Okay, so the point I'm trying to make here is that the market looks ahead, which is kind of why people are still sort of astonished about why the market keeps rallying even today, and that's because it is looking forward to 2021, 2022. We all know there's going to be a very, very deep recession this year. But what most economists expect, and what the market also expects, is that a lot of that lost GDP will be recovered next year, and it will be fully recovered in 2022, with the one big caveat, and this is a really critical caveat, that we don't get reinfections, we don't get a second wave of the virus, and we get some sort of vaccine sometime in 2021. So far, the evidence it seems to show, on the basis of what we know now, that we're making progress towards those things. Okay, and if that continues, then the market will continue to rally, even if unemployment, which is a lagging indicator, even if unemployment goes up significantly, which we all know it will. Okay, so that's the market. Now, what gives me confidence that this is not going to be 2008 all over again? What gives me confidence that the end result of what we're seeing now, is we are in a better place? Okay, so 3 reasons why that's the case. Number 1, our starting point now is a much healthier financial system. Now, a lot of us are property investors for obvious reasons on this webinar, or planning to be property investors. And the one big thing for property investors, the one big factor driving property prices, has always been the availability of credit. Because property is a leveraged asset class, it's a levered asset class, most people need lending, bank lending specifically, in order to buy property. Okay, so it's a critical factor supporting the property market. So what I looked at was the bank's capital adequacy ratio. Okay, so this is a pretty key indicator for the health of banks. Okay, so here's the chart. And this is the bank's capital adequacy ratio. Look at it as a health indicator for banks. Okay, it shows how much capital the banks have, how big a cushion they have on balance sheets, how healthy are they. Think of it like your property portfolio. How much equity do you have in your portfolio? Okay, the more equity you have, the more you can withstand any shocks. In the same way, the more capital banks have, the more they can withstand any shocks. So you see, in the run up to 2007, they were lending like there was no tomorrow, right? You all remember, or you might have heard of, Northern Rock lending 120% loan to value mortgages and that sort of thing. Okay, so they were going nuts in terms of lending. Okay, and that was probably the biggest reason why we had that big, massive recession, shown by this grey sort of shaded area. The banks were just so weak by that point, added to the fact that all their loans were going bad. The housing market had collapsed, which just added to their bad loans. Right? They were just not in a place to be able to start lending. They were fighting for their lives. Okay. And so what the governments made the banks do after that, they said, look, we're never going to have this again. So they made them clean up their act. So it took them 10, 12 years to make this line go up, make their capital positions stronger to where we are now. So we're at historically high levels here. And so what I'm saying is that the starting point for this recession is much healthier from the banks and from a lending point of view. And as I said earlier, for property, there's probably no better indicator than the state of the banking system. Okay, so like it or not, we're all going to be still dependent on banks for mortgages and things. Okay, so the next indicator, we have a much healthier housing market compared to 2007. Okay, so the first indicator is house price to earnings ratios. So you look at 2007, not just the level, which was at a peak, but the acceleration of this level running up to 2007. You see, it was at 6.5 times. This data is from Nationwide, and this is UK house prices to earnings. And in 07, 08, 09, we had that huge collapse in the market, peak to trough around 19-20% in UK house prices. Okay, and then we had a bit of a recovery since then, and in the last 2-3 years, that measure has kind of tailed off because of Brexit and various other things. So it's looking better compared to 07. We haven't just been through an acceleration. And you look at first-time buyers. This is an affordability measure. So again, from Nationwide, this measures first-time buyers' mortgage payments as a percentage of their incomes. Again, looking much healthier than 07. You see that 07 peak, and you see where it is now, below long-term averages. And we all know that first-time buyers, that is a key sort of foundation for the housing market. And so it's another solid indicator. And finally, government support and QE. Going back to previous recessions, not just 08, we go back to the Great Recession, the Depression in 1929. And, back then, governments and central banks were well behind the curve, okay, in terms of their responsiveness. We're talking about QE, monetary stimulus, fiscal stimulus. They were behind the curve. And this time round, they were well ahead of the curve. We had a very quick announcement by the Chancellor of various measures, furlough, emergency loans, grants, and we had QE, which was announced very, very quickly, okay? So a lot of people have raised concerns about the debt levels. Okay, so you've got all of this support that the government is giving. What's that going to do to debt levels? Okay, and yes, absolutely, debt levels are going to increase. The budget deficit is going to increase. Okay, so what I did was compare what's going to happen post-COVID on the right here, these dotted bars, compared and put that into a historical context. Okay, so you look at the orange bar, the budget deficit is going to rise from 2% at the end of last year to probably 10%, if not maybe more. Now, is that a disaster? Well, look at it against historical peaks, and we're still within historical ranges, okay? Which budget deficit peaked at 12% before. So it's still manageable. It's still manageable. In fact, we worked hard to get the deficit down to where it was here, 2%. And in a way, that's been a real blessing for us, because if you imagine we didn't do that, and if we'd stayed at 10-12%, we'd now be looking at potential budget deficit of 20-22%. Okay, so there's been positive economic management. We have to give the Tories that much, all right? Okay. But look, we're going to stay within historical ranges in terms of the budget deficit and in terms of the overall government debt. Again, assuming we don't get that dreaded second wave of the virus. If we do, all bets are off. So yeah, okay. And in an emergency situation, we can be forgiven for increasing our debt levels from here. So yeah, that's those are the 3 points: government support, a healthier housing market, and a healthier banking system, which is why I have a very strong belief that we're not going to revisit the 2008 problems that we had before. Okay, so I think I'm going to just wrap it up there, because I can see we're kind of getting to that 20-minute level, I think, Richard, and hopefully there's time for questions.
Yeah.
Oh yeah, just leave my contact details there. If anyone wants to, send me emails, questions. Very happy to do that. And my website's investlikeapro.co.uk. So yeah, I think I'll leave it there, Richard.
Yeah, Manish, can we just go back to your slide, the last slide you showed on the historical UK debt levels? That's the one.
Yeah.
So just explain to perhaps viewers tonight, when you talk about the deficit, what that actually means.
Sure. Okay. So
you explained that Osborne and Cameron, when you referred to the Tories, took steps, which most of us know, but I think perhaps some people are not completely clear what that term means.
Yeah, sure. So yeah, that's a really important point. So think of the budget deficit like your overdraft. Okay, so the government tends to run an overdraft year after year. Okay, so that's their budget deficit. So you can see that orange line's always been greater than zero. So you know their overdraft, i.e., their tax receipts less how much they're spending on a yearly basis. Okay, so they generally spend more than they receive in tax receipts. So they're always running an overdraft.
So really, it's just about getting the overdraft down on an annual basis.
Yeah, correct. Yeah, so there are two things. One is the level of the overdraft, and second is servicing that overdraft. And
Yeah.
right now, interest rates are at historically low levels. Some people might have seen that actually government bond yields actually became negative for the first time ever. So right now, it's actually a great time for the government to be borrowing money and to be running this overdraft because they're not paying anything in interest payments. So you know, it's a great time to be borrowing right now.
Okay, I mean that's really what I was teeing you up on that one, Manish. But anyway, okay, so let's go on to the attendee questions. So the first one's from Lorna Graham, and I think from judging from the way the question's posed, that maybe she's disagreeing slightly with your comment about the timing of the the bottom, whenever it was March 19th or whatever it was, she say what the markets rallied due to the governments around the world rescue deals and the bailouts. Yeah, they certainly responded to that. It was unprecedented to use that much overused word. Manage.
Well, look, I mean, the government response was strong. It was ahead of the curve, and there is no doubt it's helped. It's helped asset prices. Okay, it's helped stock markets. It's definitely helped fixed income debt yields. Okay, and you can argue it's going to help the housing market. So I'm absolutely not denying that at all. In terms of timing, I'd have to go back and check the dates, but I am pretty sure a lot of these announcements were made, you know, days before the market bottom. We'll have to check the dates on that. But there were certainly days I remember after these measures were announced when the markets were still getting absolutely crucified on a daily basis. So yeah, it's, you know, the most important thing is that for the markets was that there was light at the end of the tunnel in terms of the problem that was around us, and that's the C word. That's the virus, and people and markets were seeing some light at the end of that tunnel.
Thanks, Manish. Laura, I'm going to go on to your next point in a minute. Let's just clearly, as you've already articulated, Manish, we are into and I'm you know, in terms of a recessionary phase. So this question from Tej Singh. So he's asking, what does a recession tangibly mean for property and investment? Will people struggle to pay their rents? Will there be down valuations? Will there be cheap borrowing? And will flips be selling for less? Those are the points that Tej is making.
Yeah, okay. So over the medium term and the long term, the state of the housing market will be dictated by the level of demand for housing. Right, and supply, of course, but let's just focus on demand. And demand is a function of you know, a few things, but unemployment is absolutely one of those things, or employment is one thing. Okay, so if we get to a point where unemployment rates are going up to 15-20%, then the housing market's going to be in trouble. There is no question about that. Right now, the consensus forecast for unemployment rate is to go up to 6-7%. I've got the chart somewhere, but it's 6 or 7%. Okay, where the unemployment is expected to go up to.
You're showing your screen, Manish. You realise that?
Okay. All right. Okay. I'm actually going to show you a chart. Okay. Here we go. This is something I was looking at earlier. Okay. Can you? I don't know if you can see that, but the unemployment
Yeah,
rate
see
peaked
that?
around
Yeah.
8% in '08 and previous peaks. Here, this kind of grey line is the forecast. Okay. So the forecast rate is to go up to about 7%. Okay, and then come off from there. So within those levels, what that implies is, yes, there's going to be a lot of permanently lost jobs, okay, that will not come back and will stay at those levels. And then we expect activity to rebound next year and the year after, okay? So at those levels, it's manageable, okay? We've been there before. We've been there in 2012, 2013, and at that time, the housing market from memory was already in an uptrend, okay? So we can be at a level of 8-9% and the market could still be going up, okay? It's happened before and it can happen now. The real problem is if the unemployment rate goes up to 10, 12, 14%. That's when we're in trouble. Now, how is that going to happen? If we have a second wave, if we get a reinfection rate, which is why I was saying, you need to keep a really close eye on infection rates and second waves around the rest of the world, right? Not in the UK, because there are leading indicators in Asia and elsewhere in the world. So keep an eye on Italy, Spain. Keep an eye on those, and if it looks like the infection rates are going to go up again, don't do flips. Because the housing market will be in trouble. But my base case is that we're not going to get to those levels. My base case is that when we started off, I was thinking 10-20% declines, but my base case is probably more like high single digits as a decline now.
And on that point, I'll ask a question, Manish. I mean, do you see London and the major cities in the UK that are more densely congested, more reliant on public transport systems, do you see those, and also offices, congested offices, etc.? Do you see London, maybe Birmingham, Manchester being more impacted ahead or not?
Yeah, I think so. I think any sort of city, densely populated, dense office-based districts. So we're talking about the City of London. You're probably going to see a bigger impact here. If you imagine a situation where people don't necessarily need to be going into work, companies might realize actually people are as productive working from home, so they might want to downsize their offices, right? So say to people, work from home more often, and if that's the case, you don't necessarily need to be so close to the city. You can live in suburban areas and tier 2 cities and tier 3 cities. So I think some of these tier 1 cities, zone 1, 2 in London, that will probably be under a lot of pressure, more pressure than the UK average, I would guess.
Okay, thanks. Yeah, I mean, it was just something I've been thinking about for an upcoming article, so I just thought I'd pop that one in. Let's move on to get some more questions answered from the attendees tonight. This is from Anton's. He's referring back to the observations made about the budget deficit, and you're showing the orange line screen at the moment relating to that. His question is, what are the negative consequences of a rather large or larger budget deficit?
Yeah, I mean, if it goes up to, where are we now? Expected to be 10%. If the expectation is 20%, 30%, that's not a good sign, because that indicates that we might have a second, third wave or whatever. But in itself, it's not great, because it means that the government finances aren't in a good place. And what that could lead to is that investors who are currently investing in government bonds, they decide to flee that market, and that will increase the cost of borrowing for governments. And that has a flow-through impact for companies and for households as well. So it will drive up the cost of borrowing for everyone in the economy, and we'll probably get downgrades from credit agencies like the S&P, Moody's, and all of those guys. So that won't be a good scenario at all.
Okay.
But just balancing that, if interest rates stay low, the servicing of that debt, on the other hand, is a positive. Okay, so just balancing those two things, but overall not positive.
Right, but that's not yet where we're possibly will be at. There's some quite in-depth questions, so let me just get some of the more straightforward ones out of the way. And if we've got time in the next 10 minutes, then We'll allow 10 minutes. Okay, so Lorna is clearly not convinced of your base scenario. It's Lorna Graham who asked a question earlier, and I said I'd come back to Lorna's second point. She's saying the 2020 depression will be worse than the recession in 2008. Well, I think that's possibly already being, given. What are your thoughts on that, Manish?
There is no doubt. There is no doubt. No one's arguing it's not. I mean, it's going to be much worse than the 2008 recession on so many levels: unemployment rate, GDP, economic activity. I mean, it's obvious, right? 90% of the high street is closed down, so it's pretty obvious we're going to get horrific GDP numbers and earnings data and all the rest of it. That's not the argument. That's not my argument. The argument is that because of our starting point, this is going to be a short, sharp decline in activity, and then we're going to get that bounce back next year and the year after, right? This is the base case. This is not just my expectation. This is most economists who are expecting this. This is what the market is expecting as well. Okay, so a short, sharp recession, decline in activity, followed by a short bounce back next year.
Okay, I had a piece in today which hasn't even got to our website, never mind into print magazine, and the headline was Alphabet Soup, and it's referring to what you've just described that we have ahead for us, ahead, as in the future, which is a V shape. Lots of people have been talking about U's and L's and then a W. But one point, so that's just picking up on that. But I've got a question from someone I'm sure you know quite well, which is Helen Chorley. Good evening, Helen. And Helen is asking, or she's saying, the banks, she agrees with you on this, Manish, absolutely, that the banks were certainly are in a much healthier position up until recently, perhaps, is what she's insinuating here, than they were in 2008, which is why obviously they had such a massive liquidity problem at that time. But haven't the capital adequacy ratios now been relaxed? And is that concerning, is the point Helen's making?
Yeah, very good question, Helen. Helen knows this space really well. We both used to work at JP Morgan at the same time, I think, during the last financial crisis. So, yeah, it's a really good point. Have the banks' criteria been relaxed? I think I think she might be referring to what's happened in the very recent past post-coronavirus. So the banks have been asked to sort of lend out again. I think that's what she's referring to, right? I'm not sure if this is a strategic sort of change to their overall policy, but if it's a response to the virus and the economic issues we've got ongoing right now, yes, they have been asked to sort of relax their lending, and the way governments are looking at banks is that, look, we did you a favor in 2008, we bailed you all out, so it's now time for a bit of repayment, and they're going to be asked to. They've already been asked to cut their dividends to shareholders, and they'll be asked to lend more, and in fact they've been explicitly been asked to stop repossessions and all of those things. So yes, absolutely. Look, they owe us one. So and because they're in a much healthier position, they are they have better willingness and ability to help the economy this time round. I'm not sure. So it's great in this situation, but what they're not going to do at the end of the day, most of them are private businesses, right? So they want to protect their own interest. They don't want to take on dodgy loans, and they're only going to lend out if it's a safe bet. So they're all very happy to give out these bounce back loans because they're fully underwritten by the government. So they're very willing to do all of that because it's risk free for them as well. But generally they're in a better place to be lending.
So the point Helen's raised, and the way you just responded, Manish, that there was a fairly sharp intake of breath reflected in the way that the first tranche of loans, that the 350 billion, etc., that was floated around, and actually the uptake of those I'm trying to think of the acronym, but it was the first big announcement on corporate support, and that seems to have, that fell fairly flat because the banks were on the banks had 20% risk at stake with that, didn't they?
Correct. Exactly right. So they're still private enterprises. They're still responsible, accountable to their shareholders. So they don't want to be taking on dodgy loans right now. And the bounce back loans, in contrast, was very well taken up by banks and by borrowers because there's no risk there. Yeah.
Thanks. Okay, so question from Anil. He says, good presentation and data point. On a scale of 0 to 10, with 10 being strong, confident, healthy, being best, how do you rank using only econometrics data sets the UK's economy strength now versus 2008 behaviour post COVID-19, if that will ever be 100% possible moving forward? So it's where I think he's like, where are we positioned now relative to where we were 12 years ago, perhaps? Yes.
Yeah. Okay. I don't know about a scale, but look, we're in a much better position now compared to 08 for the reasons I mentioned earlier. So a much healthier banking system. The housing markets are great, are in a much better position, and yes, we've had better government policy response. Whenever you look at historical depressions and issues with the economy and the markets, you look back over history, it's always been characterized by a huge acceleration in credit, right, or a huge acceleration in asset prices. One of those two conditions have almost always been in place. You look back at 2008, you look back at 1929, all the big depressions and recessions we've had over history. That's always been the case. And this time round, they were not there. It was a virus, okay? And the virus is pretty tragic in terms of deaths and all the rest of it. But from a purely economic point of view, we have to realize that it's not the same. And the other thing is, we've had viruses before, right? We've had SARS, we've had Ebola, we've had bird flu, and over recent history we've had terrorism. And I remember in 9/11, people were saying this is going to change the world economy forever, and people are going to stop using tall tower blocks. They're going to stop living in tall tower blocks. They're going to stop working in tall tower blocks. There's always this situation when you're in the middle of a crisis that things will never be the same again, and this is the big one. And we get over it, right? We get over it. But in terms of the underlying health of the economy compared to previous problems and previous historical events, we're in a much better position. Okay, now, and look, I am sounding positive here, but I constantly caveat everything I say with the threat of a second wave and reinfection rates, because if that happens, I'll be very, very quick to change my position, because that will be pretty ugly for the economy and all the markets, okay, and confidence overall. So we always have to bear that in mind.
Thanks, Manish. Moving on to a very, very important subject, and as someone whose spouse fixed a mortgage at 11.5% back in 1989, and actually, in fact, that was a good move at that time. This is a question from Akil. Good evening, Akil. He says, clearly this is like no other recession. Assuming GDP tumbles, unemployment rises, are we going to see interest rates rising rapidly in the next 10 years?
I'm not sure why interest rates would rise in that scenario if you've got a deep depression and unemployment going through the roof. That wouldn't make sense. So he might be referring to inflation as a result of all of this QE, which leads to interest rates. So there's a bit of a misconception out there, which is that all this QE is going to lead to inflation, and I would strongly suggest that it's not going to lead to inflation. So how QE works, okay? So central banks create a load of money, which then goes out and buys government bonds, okay? And what happens with that money, it stays in the financial system. It generally stays in the financial system unless the banks who can get access to that money decide that conditions are so great that they can start lending again like they did in 2007. So unless there is huge confidence in the economy, that money is going to remain within the financial system. Okay, so an inflation only accelerates if you and I receive that money somehow, it ends up in our pockets and we start spending like there's no tomorrow. If we start spending, then demand exceeds supply and prices start going up, inflation starts going up. But if we don't receive that money in the first place, then prices are not going to go up. And now you might respond and say, okay, we've had all of these loans come through and these grants and bounce back loans and all the rest of it. But most of that money is going to end up in the property market or in asset markets or something. So you need two conditions for inflation. One is to actually have the money in the first place. And the second condition is to go out and spend it. But most people, if they did receive that money, will just end up saving it or investing it. So I don't see inflation ticking up. In fact, you look back at Japan. Japan was the modern day pioneer of QE. It's been doing QE for 20 years, okay? And the problem in Japan has been deflation, not inflation, over the last 20 years. So I'm pretty convinced we're not going to see inflation rise anytime soon. Okay, and interest rates will remain ultra low, just like they've done in Japan.
Fine. We've got some experienced people and some sharp minds on this call tonight. And one of those I know is Kwasi. Good evening, Kwasi. So very short, straightforward question here from Kwasi to you, Manish. What are the things that could stop it being a short, sharp V recession?
Good question, Kwasi. Yeah, I would say there are three risk factors, okay? People should be keeping an eye on these three risk factors. I've mentioned numerous times a recurrence of the virus. That's the big near-term risk factor. Look at leading indicators in China, Korea, Japan, where the virus happened first, okay? Look at Spain, Italy, look at recurrence rates. If there is any sign of anything happening there, you can be sure it's going to happen here. That's one. Number two, what I'm really worried about is it's kind of ongoing tensions with China, right? Trump and China are not best friends at the moment. If that, if that sort of ratchets up in terms of tensions, that's going to be really bad for the global economy, because the global economy is still very reliant on China. And it works the other way as well, right? So that's not going to end very well. And the third thing is, although I think it's a very low likelihood in terms of inflation, if inflation did start going up, if I was wrong about my view on inflation, that again could become really ugly, because if inflation goes up, there is pressure for interest rates to go up to contain that inflation. And because of all this debt and asset prices would be absolutely pummeled if interest rates started going up meaningfully. As I said, that's a very low probability, but if it does happen, all bets are off. So those are the three risk factors I would be keeping an eye on.
Thanks, Manish. I hope that helps you a little bit, Kwasi. Yeah, going to have time for two more questions. We're already running over time, but the quality of the questions is good, and clearly lots of you are engaged. Lots and lots of people are still on this webinar. So I'm going to just continue, if Manish doesn't mind, another few minutes. If that's okay with you, Manish, is it?
Yeah, happy to do that. Yeah,
a few minutes more, just because so many questions. Commercial property is taking a battering and has done over the years since Amazon, obviously talking about the retail sector there. What are the opportunities for real estate / commercial property investors, bearing in mind repurposing, permitted development and growth areas? And that's a question from Akhil Mir.
Yeah, good question, Akhil there. Actually, what I just want to plug another article which I wrote for Property Investor News, and this is going back to August to September, okay? And what you may remember this one, Richard, and hopefully others do as well. So I was kind of just giving people a bit of a balanced view on commercial, because I remember at the time commercial was the only game in town. That's what people were just talking about, you know, all the time. It was the new kid on the block, right? It was the latest bandwagon. And I was just trying to remind people to be mindful that in recessions, it's commercial property that has the highest beta. In other words, it has the highest risk factors because of, you know, the various reasons on how commercial valuations are done. And yeah, it's going through a bad time right now. I'd be worried about big offices because of the reasons I mentioned earlier. So people, big companies will be downsizing their office space. So big offices will be in trouble. Retail is clearly going to be in trouble. That trend is just going to accelerate. But the office thing is, it might present interesting opportunities for people looking to do commercial to resi, because if there's a load of big offices in trouble, if there's a load of supply out there in the market, you might get that opportunity to purchase big office buildings potentially. Coming into this, before this recession, I was looking at prime grade A office space in London and in the city in the West End, and they were trading on like sort of 3.5% yields at their peak. I was thinking, this is just far too expensive. I mean, this is not sustainable. And, those yields will probably go to 4 or 5%, I would imagine, if not more. So those will be opportunities, not just in London, anywhere in the UK, to be looking at big office buildings. Retail, as I said, those trends will just probably accelerate, and there might be some interesting opportunities in the industrial space as well. So yeah, I think those are the areas to look out for. But in general, commercial property will always underperform residential property in a downturn.
Good comment. Okay, I'm going to give you one question, and it's from 3/4 different people, and it relates to Brexit.
Oh,
forgotten.
Okay.
Forgotten.
What was that?
So Mariola is saying she can buy the scenario that you lay out. Andy is saying, has your analysis taking account of? And Danielle is also saying the same thing. Basically, Brexit, if it goes pear-shaped in terms of where we're at the moment, and I was reading something at the weekend in relation to that. I'm not going to go into it now, so I've answered Mariola's. So I can buy the scenario that you lay out, but if Brexit goes ahead as planned, oh, hang on, this is the second one. She's saying if it goes ahead as planned, how do you think the second shockwave affects that second shockwave? In other words, Brexit going ahead. Whereas Andy's saying the same thing, whereas Danielle is saying of a non-deal Brexit on top of the current pandemic. So 2 yes and 1 no on Brexit, and then there may well be another one, but I think that's enough for one question, and I think we're going to have to close after that question being answered.
Yeah, okay. The Brexit, the good old Brexit. Wouldn't we?
There's always a googly in a cricket match. There's always a googly that comes up.
Yeah, what we wouldn't give to go back to the good old Brexit days. Yeah. So look, I think a bad deal on Brexit cannot be a good scenario in any situation. Okay. Whether we are in a recession or not, right? Whether we've got the coronavirus or not, it can't be a helpful situation for the economy or the property markets. So let's start with that. And so clearly, a bad deal or a sort of no deal Brexit is going to just add to any issues we will be going through at the time. I just can't see us. We were already in a pretty poor bargaining position versus Europe right, versus the EU in terms of what we wanted to get out of the Brexit negotiations. And now I can't believe anyone in their right mind, not even Cummings, or if he's still around, whether he's coming or going, you know, I just can't see.
Let's go there, Manish.
Yeah, I just can't see us even contemplating a no-deal Brexit. Okay, so I just think that's well off the cards. But if it does happen, clearly a negative. I think, you know, very, very low probability, but you know what we've just been through, it probably increases the probability that we may not even do a Brexit. Okay, you know, by a very small amount. The probability is very small, but that probability has to have increased given the virus and all the rest of it. You know, because now, you know, you've got excuses to do lots of things that you couldn't have done, that couldn't have been politically acceptable before the virus. So yeah, I just don't know. I don't have any strong views on it, but a bad deal Brexit, a no deal Brexit's not going to help.
Right. Okay. We are well over time, and I did say that we'd finish at about 10 to, and it's now almost 10 past, which is unprecedented. So, Manish Kataria, Mani Chopra, Romy Chopra, thank you very much for your participation tonight. Some great content. As I said earlier, we could have probably, you know, we could have gone on probably another hour, but you guys have all got lives to get on with and children to look after. Thank you very much for all of your time tonight.